Is keeping cash in the bank really safe? That's a question that many of us often ask ourselves. It's a question that's deeply ingrained in our financial psyche, instilled in us by generations of cautious savers who believed in the sanctity of the bank vault. We've been conditioned to equate banks with safety, to see them as impregnable fortresses of financial security. But is that really the case? Let's examine this common perception a bit more closely. When you deposit your hard-earned cash into a bank, you're essentially lending your money to the bank. In return, you expect a sense of security and maybe a modest interest. But is your cash really risk-free? Consider the silent, insidious forces that erode the value of your cash over time. The first of these is inflation. Inflation is a bit like a stealthy pickpocket, quietly snatching away the purchasing power of your cash. As prices rise, the same amount of cash buys you less and less. It's a slow but steady erosion of your wealth that can go unnoticed until it's too late. Then there's the issue of low interest rates. In a world where interest rates barely keep pace with inflation, the real return on your cash in the bank is often negligible. In fact, once you factor in inflation, you may find that the real value of your money is actually shrinking, not growing. Finally, let's not forget about the potential for bank failures. While rare, they do happen. And when they do, the safety of your cash can be compromised. So where does this leave us? It's crucial to understand that while banks play a vital role in our financial system, keeping all your cash in the bank isn't without its risks. In reality, the so-called safety of cash in the bank is but an illusion. What if there were safer and more profitable places to store your hard-earned money? Now that's a question worth pondering. Let's dive into the world of assets and discover why they differ from cash and how they can potentially offer a higher return on your investment. Firstly, let's demystify the term assets. In the simplest terms, an asset is something that puts money in your pocket. It could be a business, real estate, stocks, or even intellectual property. Cash, on the other hand, is simply a medium of exchange. It's what you trade for goods and services. Now, why should you care about assets? Well, the answer is twofold. Firstly, assets can provide a consistent stream of income. Think of a rental property that earns you monthly rent or a business that generates regular profits. Assets like these keep money flowing into your pocket, even when you're not actively working. Secondly, assets have the potential to appreciate in value over time. While the value of cash can erode due to inflation, assets like real estate and stocks often increase in value over the long term. This means that not only can your assets provide you with income, they can also grow your wealth over time. But what's the catch, you ask? Well, like all good things, assets come with risks. The value of your assets can go down as well as up. There's also the risk of illiquidity, where you might not be able to convert your assets into cash quickly when you need it. However, with careful planning and management, these risks can be mitigated. So, is keeping cash in the bank a mistake? Not necessarily. Cash is important for day-to-day transactions and for maintaining a safety net. But if you're looking to safeguard and grow your wealth over the long term, then it's worth considering the power of assets. When it comes to safeguarding and growing your wealth, assets are the real game changer. So, let's delve deeper into the world of assets in our next scenes, where we'll explore real estate, stocks, and cryptocurrencies. Stay tuned. Let's delve into the first of these assets, real estate. A timeless classic in the world of investment, real estate has long stood as a solid, reliable avenue for wealth generation. But what is it about real estate that makes it such a popular choice among investors? Firstly, let's talk about the potential for rental income. When you invest in a property, you're not just purchasing a building or a piece of land. You're acquiring an income-generating machine. Residential properties can be rented out to families or individuals, while commercial properties can be leased to businesses. This provides a steady stream of income, making your investment work for you day in and day out. Next, we have appreciation. In other words, the potential for your property to increase in value over time. While the real estate market has its ups and downs, the general trend has historically been upwards. If you hold on to your property for a number of years, chances are its value will grow. This allows you to sell it for a profit down the line, or even leverage that increased value for other investment opportunities. Let's not forget about the tax benefits that come with real estate investment. There are numerous tax deductions available to property owners, including mortgage interest, property taxes, operating expenses, depreciation, and even the cost of traveling to and from your property to manage it. These deductions can significantly reduce your tax burden, making your investment even more profitable. Now, onto the stability and tangibility of real estate. Unlike stocks or cryptocurrencies, which are essentially digital entries on a ledger, real estate is a physical, tangible asset. You can see it, touch it, even live in it if you so choose. This tangibility provides a level of stability that other investments simply can't match. It's not subject to the whims of the stock market or the volatility of the crypto world. Instead, its value is tied to the real world, to the land it sits on and the bricks and mortar that make up its structure. Furthermore, even in times of economic downturn, people will always need a place to live, and businesses will always need a place to operate. This means that demand for real estate remains relatively steady, even during financial crises. This stability makes real estate a safe harbor during stormy economic seas, providing both income and peace of mind to investors. So, there you have it. The benefits of investing in real estate are numerous and varied, from rental income and appreciation to tax benefits, stability, and tangibility. It's an investment that works for you, that grows in value, and that provides a level of security that's hard to find elsewhere. Real estate offers a stable and tangible way to grow your wealth. The next asset on our list, stocks. Let's delve into the world of stocks, a type of asset that is, without a doubt, liquid. The term liquid in this context doesn't refer to a state of matter, but rather to how easily an asset can be converted into cash. Stocks, being readily sellable on various exchanges, are considered highly liquid. Now, why would one consider investing in stocks? Well, there are several compelling reasons. For starters, stocks have the potential for high returns. While it's true that the stock market can be volatile, historical trends show that over the long term, stocks tend to provide a higher return on investment compared to other types of assets. Another enticing feature of stocks is the opportunity to earn dividends. Not all companies offer dividends, but those that do provide their shareholders with a portion of their earnings on a regular basis. This means that as a shareholder, you could be earning money simply by holding onto your stocks. It's akin to having your cake and eating it too. But of course, investing in stocks isn't just about buying and waiting for dividends or for the stock price to go up. It involves a good deal of research and understanding of the market. You'll want to know about the company you're investing in, its financial health, its competitive position, and the overall market conditions. And let's not forget the importance of diversification. It's never wise to put all your eggs in one basket, and the same goes for investing. By spreading your investments across different stocks and even different types of assets, you can reduce the risk of significant losses. Now, a word of caution. The stock market isn't a get-rich-quick scheme. It requires patience, diligence, and a willingness to learn. There will be ups and there will be downs. But the potential rewards can make it all worthwhile. So, do stocks sound like the kind of asset you'd like to have in your investment portfolio? If you're attracted to the potential for high returns, regular dividends, and the liquidity that stocks offer, then they might just be a good fit for you. Remember, though, that investing in stocks isn't a decision to be taken lightly. It's essential to do your homework, understand what you're getting into, and be prepared for the inevitable bumps along the way. And always consult with a financial advisor or a trusted professional before making any major investment decisions. Stocks can provide high returns and liquidity, making them a valuable asset in a diversified portfolio. Finally, the last asset we will look at today, cryptocurrency. This digital asset has taken the world by storm in the last decade, becoming a buzzword that's hard to ignore. But what exactly makes it a viable alternative to traditional assets like cash, real estate, or stocks? Cryptocurrency, in its simplest form, is digital or virtual currency that uses cryptography for security. It's decentralized, which means it's not controlled by any government or financial institution. This decentralization offers a level of freedom and privacy that traditional banking systems simply can't match. Moreover, cryptocurrencies are built on a technology called blockchain. This technology is a decentralized system that records all transactions across many computers so that the record cannot be altered retroactively. The potential of blockchain technology extends far beyond cryptocurrencies. It's being hailed as the future of secure and transparent transactions, from supply chain management to secure voting systems, and even digital identities. Now let's talk about the elephant in the room, the potential returns. We've all heard the stories of early adopters becoming millionaires overnight. While these stories aren't common, they do highlight the high potential returns that cryptocurrencies can offer. But with high potential returns come high risks. Cryptocurrency prices can be extremely volatile. They can skyrocket one day and crash the next. This volatility can be nerve-wracking, especially for those who are new to the world of investing. But it's also what makes cryptocurrencies such an exciting asset. It's a bit like a roller coaster ride, thrilling, unpredictable, and not for the faint-hearted. However, it's important to remember that, like all investments, you should never invest more than you can afford to lose. It's also crucial to do your own research and understand the market before diving in. There's a wealth of resources out there to help you understand the ins and outs of cryptocurrencies, from online courses to forums, blogs, and social media groups. It's also worth noting that investing in cryptocurrency doesn't mean you have to buy an entire Bitcoin or Ether. You can invest in fractions of a cryptocurrency, making it a potentially accessible investment for many. In conclusion, cryptocurrency is an exciting and revolutionary asset. Its decentralized nature offers a level of freedom and privacy that traditional banking systems can't match. Its potential returns can be astronomical, and the underlying blockchain technology represents the future of digital transactions. But, like all investments, it comes with its own set of risks. Cryptocurrency is a high-risk, high-reward asset that represents the future of digital transactions. So, is keeping cash in the bank really the safest option? To answer this question, we've dissected the illusion of safety that banks often represent. We've also delved into the power of assets and how they can work in your favor, providing an alternative to the minimal returns that a traditional savings account might offer. We started the journey by understanding the value of tangible assets, particularly real estate. A piece of land or a building is a physical entity that you can touch, see, and use. It's a piece of the world that you own. And over time, this asset often appreciates in value, providing a return on your investment that a bank's interest rates would struggle to match. Then, we explored the world of stocks. These liquid assets offer a piece of ownership in a company and the potential for significant returns. Navigating the stock market might seem daunting initially, but with a little knowledge and patience, it can be a powerful tool for growing your wealth. Remember, the key is to invest in companies you believe in and understand. Our journey didn't stop there. We ventured into the digital realm, exploring the potential of cryptocurrencies. This asset class has been making headlines for its meteoric rises and falls. Despite its volatility, it offers an exciting opportunity for those willing to embrace the risks. It's a brave new world out there, and cryptocurrencies are at the forefront of this digital revolution. All in all, keeping cash in the bank may seem like the safest option, but it's not necessarily the most profitable one. By investing in assets like real estate, stocks, and cryptocurrencies, you're giving your money the chance to grow, to work for you. It's about taking calculated risks and making informed decisions. Remember, when it comes to your money, the real safety lies not in preserving it, but in growing it.